All righty. Hello, everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I'm a coach and senior manager with Schwab, and we have got, as always, a lot we want to cover today. Yeah, hit refresh if it doesn't look like you hear me talking. Yeah, and because we are live and we are rolling. I have got Mr. Scott Thompson with us in the chat today. He is a friend, a fellow coach, a manager on our coaching team, and he is extraordinary in the chat. So if you've got questions, don't hesitate to ask. What are we going to cover today? Well, I have a list of about like 15 stocks I'd like to talk about. Obviously, we're not going to get to all of them, but I thought it would be interesting to kind of go through that thought process of when we look at an opportunity, how do we choose whether we buy the stock, whether we do an option trade like a long call vertical or a short put vertical, or a directional trade if the market is bullish like a long call? How do we make those decisions? And so that's what our focus is going to be on today. If you're new to this class, this is a very active trading class. So we place a lot of trades in this class and we follow up on a lot of trades in this class. Our goal in this class for 2026 on a $25,000 account was to earn $200 a week over the course of the year. So that's our goal. If you are not following us on X and LinkedIn, you are missing out, my friends. Scott's handle, Scott Thompson CS, my handle, Barb Armstrong CS. You can also follow us on LinkedIn. So wander over to LinkedIn. And sometimes we're posting different types of content over there than we are on X because we have a longer format. So we can be a little wordier. So just to get through some important stuff before we get, into the meat of our discussion today, we do place a lot of option trades in this class and know that options carry a high level of risk and aren't suitable for all investors. We do all our example trades on the Paper Money software application on the Thinkorswim desktop platform. So that is a brilliant place to learn and hone your skills, but know that there are some differences between Paper Money and live accounts. And I'll mention those as they come up, but the most important one or relevant one for us in this class is that short option positions will never be assigned early in Paper Money. That can happen in a live account. Also know that if we use a stop loss order, it doesn't guarantee that we, just one sec. I have started. Are you not seeing me? This is. Okay, are we rolling here? Okay, good, good. Okay, sorry. I just had Scott type into the chat, we should begin any moment now. And so that kind of threw me a little. So it sounds like we're good to go. Okay, so we're good. Okay, so if you have never been to a live event, this event in New York, well, you've missed it if you're with me now. They're at the Marriott Marquis. They're doing a 2-day advanced option event with Ben Watson at the helm. Next up will be in Scottsdale, and these events are free to attend. My kids would say this is a very bougie location. It's a beautiful location, at the Phoenician in Scottsdale. It's a 1-day event, and we go from what's happening globally in the markets, how are, global events, tariffs, all that kind of stuff impacting what we do. And then right down to, and here's an example trade that, some traders might consider, placing. So we're taking it from here to here in 1 day. We'll have the coffee on in the morning. We'll have breakfast. We'll have lunch. We'll have a nice reception at the end of the day. So if you've never been, I'd highly recommend it. It's how I got introduced to the world of trading back in 2011. And, I have never looked back since. And then the next one after that will be in DC at the Ritz-Carlton. And that's a 2-day intro to options and intro to technical analysis. Okay. So, and I'll be at the Scottsdale and DC events. If you're there, come up and say hello. Would love to meet you. Okay. We do a very, very brief market overview in this class because Kevin Horner does an outstanding, like 45-minute overview on the markets at the market open 4 out of the 5 days a week. This morning it was Mr. James Boyd running because Kevin is in New York. And then we're going to focus primarily on placing some new example trades today, although we will do a teensy bit of trade management. Okay, if you are new, feel free to type a greeting into the chat so we can welcome you. But know that, we started the year with 25,000. Our goal, so we're doing short-term transactions versus longer-term like transactions. We're looking more short to intermediate in time frame. And our kind of premise was you may have a large account that is invested that you're investing from a longer term approach, but we're taking this 25,000 and saying, but what if we wanted to earn a weekly or monthly income with it? And so that was our goal, to earn $200 a week over the course of the year. Our max position size is 5,000. Our max risk per trade, $500. Okay, so let's get out to the platform. So if we start with the S&P 500, this was actually up on the day a few minutes ago. It's now down by just a smidge, but it's pretty bullish, right? It's within a stone's throw of all-time highs. It's up 12.9%, and we're not even at September yet. The average for this index over the last 30 years, including the Great Recession and all the other ups and downs, has been between 10 and 11%. Now, the NASDAQ has averaged about 13% a year over the last 30 years. It's up 16.7% year to date. And after this extraordinary move to the upside, it's been kind of consolidating. And if I were playing, I Spy with my little eye, let me just see if this is, no. I have a drawing tool it's kind of, it loves me not. So let's use this one. I'm seeing a little bit of an inverted Head and Shoulders perhaps setting up. It's not quite complete yet, but some might be optimistic, and some might say, well, I'm going to wait for this to break. But that's one thing that we can look at when something's consolidating like that. How about our VIX? Our volatility index, it's still at the low end of the range, at 14.5. So like that is indicating a relatively high degree of confidence. Our Russell it's down today, but I mean, up close to all-time highs. We're still seeing a series of, higher lows and higher highs, which is pretty bullish, right? Just hit a new all-time high for this index back the middle of August. And then if we look at the Dow, and if you're wondering, because I get questions on this all the time, where did your examples come from today? Well, the Dow is pretty bullish. Again, series of higher lows and higher highs. I went through the stocks in the Dow, and I basically just pulled up a list, public watch list, said, let's look at the Dow Jones, and I sort them alphabetically. And then we just clicked on, link your chart to your watch list, and just clicked on through. So, I got to number one on our list, Apple, little tech company you may have heard of. And, it kind of came down on earnings, which it is not uncommon for Apple to do, even when they have an extraordinary earnings report. But we're seeing here, that it's moving back up to the upside. And, this was, I believe, a new all-time high for this stock. Don't you wish you'd bought this a few years ago, right? But, when we look at where we are on this, if we come into a 6-month chart, it's been pretty bullish, up 18% year to date. So, kind of overachieving the indexes. But if we wanted to be kind of sort of bullish, okay, if we did a short put vertical, and this stock is up almost $7 today, 680 something, Could we come back here to 308 or maybe 310 and sell a put? Now, when you sell a put, you're agreeing to buy the stock. You're saying, hey, if you want me to buy this stock for 310, happy to do that. Well, we don't, want to spend all $31,000 that are currently in our account on buying the stock. That would violate our position sizing rules. But so we can turn this into a short put vertical by then buying a put underneath. So it defines our risk, which is important to us in this class. And, we aren't going to make as much as we would make by selling a put, but then we've defined our risk. And so could we come out here to say September, 21 days, sell the 310? Now, if you're looking at our trading plan or recipe, and I'll show you, where to find those. But if we looked at this 310, one, we want to see, do we have an entry? So yes. Do we trade more than 1 million shares a day? Check. Do we have lots of volume here? So at the 310, 7,000 contracts. Our guideline is we want to have at least 20 times the number of contracts we're going to trade. We aren't going to trade more than 2 or 3 probably, so check. And do we have a tight bid-ask spread? 10 cents on a $3 option. So, and we want that to be 10% or less. So if we looked at this 310 and said, okay, we're going to sell a vertical here, we get 57 cents per share, or $58 a contract. And then the next question is the juice worth the squeeze? Well, how much are we risking? We're risking 250. And so if I change this to a calculator and say, okay, if I can make $55 and I'm risking $1.95, which is the 250 I'm risking minus the 55 cents, what's my return? And our rule of thumb is if we're in it for 21 days, we want to make at least a 21% return. This would give us 28. So are we cool with that? We're cool with that. You might say, well, why not do a $5 wide spread? Well, we could, but at 57, if we're doubling the risk, we'd like to see double the credit. And here we get $1.04, not $1.14. You'd say, well, you have to pay more you have to pay more in transaction fees. And that's true. We're going to pay twice as much in transaction fees if we do twice as many contracts at the 307.50. But we're paying an extra $1.30 a contract to get in and $1.30 to get out, but we're making $10 less. So it sounds like the extra $10 we'd make would more than compensate. Now, there is another difference, and that is that the probability of it going through both strikes is lower if we sell the 305 than if we sell the 307.50 by 3%. If we're using delta as a proxy. Or here, like we can see, the probability of it being in the money at expiration is just shy of 20%, versus 23%. But this is the number we're most interested in, is in the 310. We want it to stay above 310. Okay. So we're going to make this the 307.50, and that's the rationale behind doing the $2 wide spread versus, the 5. And, if we're risking about $2 a contract, how many of these can we do? We can do 2. So we're going to sell 2 of these. And then we're changing our advanced order to first trigger sequence. And as part of our trading plan, the other thing that we say is, okay, we want to buy this back, take our risk off the table when we've got about 80% of our max gain. So if we're getting 60, we want to buy it back when it's worth about 12 cents. So we're going to make that good till canceled, confirm and send. So the most we can lose on this, 382. Is that less than 500? Yep. And the most we can make, 118. And you may say, like, that is not going to have me drinking something coconut flavored, out of a drink with an umbrella in Tahiti. And while it may not, you can buy a lot of gas or groceries for that if in fact your goal was to make $100 or $200 a week. If you could do a couple of these, you'd be good to go. You'd be meeting your goal. Yeah. And somebody else is saying, like, if the delta is 25, and the probability of it being in the money is 26.7, that means you've got over a 70% chance, of this being a successful trade. And so some people will just trade based on probabilities. I am a technical trader in that I like to look at the charts. And so I want to see both of those things. So if we want to put this on our charts, we can then come over here and say 310. And so we have done a short put vertical at 310 and 307.50. That expires September 18th. So now as soon as we look at the chart, we know what we're aiming for this to stay above 310. Okay. Okay. So there's our first trade in the bag. So, sticking with the letter A, we're going to come down to American Express. Now, the reason I brought this up in the beginning was because, and I'm going to back the truck up a little bit. So, we saw that Amex came down and then we had this cup and handle pattern. It broke out and it's come down and it's been flirting with this old resistance looking like new support. And so we could look at this again Monday and say, yeah, well, like on this day here, this would have been considered a bullish entry, but it's been kind of hammering about and dojiing about. And today we have an inverted hammer. Do we really want to assume that this is going to hold? But then when I came to the trade tab earlier today and looked at this, the bid-ask spread was too wide. Like now the bid-ask spread has settled down and this would actually be considered tradable. But if we're following our entry rules from a candlestick perspective, when we have a doji like this or an inverted hammer, these require confirmation. And so what do I mean by confirmation? What I mean is that we want to see a close above the high of the low day. And have we seen that yet? We have not. So, do we follow our rules or not? Well, I'm suggesting that yes, we want to follow our rules. And so where do you find these rules of which I speak? And I know a lot of you usual suspects, you know this like the back of your hand and you got it buttoned down. But if you don't, you're going to want to subscribe to the Trader Talks channel from Schwab Coaching. And when you do, what you'll see when you first come in to Trader Talks is what's currently being taught. But if you come to these playlists and then scroll down, there's a playlist for this class. And somebody did a bunch of binge learning by watching these last week. I know because they commented on all of them and I will comment back. But there's this group called the Trade Management Mini Sessions. And, so if you're wondering, when I'm talking about what is this hammer and confirmation, this was the first one I recorded. It's 5 minutes long. You could do a little binge learning on candlestick patterns. You can also join us Tuesdays at 2:00 Eastern for getting started with technical analysis. But this short put vertical that we just talked about, here's an example trading plan. And it covers the 5 critical areas, right? What to trade, when to trade, how much to trade. So that's our position sizing. When to exit, both if the trade goes for or against you. And then what are your routines? Okay, so routines, we haven't talked about routines. Well, if we come here, one of the things I filled in for Brent Moores a couple of weeks ago, and I will put at the end of this webcast a link to that webcast where it was, how to manage an options portfolio. And so one of the things we did is we said, we are going to, if we look at our short put verticals, we're going to look at those every day. Now, Microsoft, we want to get out when we're at 80% of our max gain, and we're at 78%. Now, I don't see an exit here. And so with this, we might want to say, okay, come up and look at our working orders. I have these alphabetically. Oh, and so I wanted to buy this back when it's worth 22 cents. So this got filed somewhere else. So I want to move this to the short put vertical group. Okay. Now, what about JP Morgan? This one doesn't have an exit either. Why is that? That should, our little chicklet here. JP Morgan doesn't have an exit order and there isn't one in here. So maybe when I put this order in, I made a mistake and I put it in as a day order. And our guideline on short put verticals is when we've got 80% of our max gain, we want to exit the position. And so we're going to highlight this position, right click, create a closing order to buy it back when it's worth we sold it for $1.70. So when it's worth 34 cents, we want to buy it back. We're going to make that good till canceled and put that in. Okay. Okay. And then the other thing that we did is we created a watch list and I called them all my. I started them all with my so that they would all be grouped together. So here's my short put vertical watch list. And then when I bring this up, we've just added Apple to our short put verticals. So I'm going to come down here and add this so that if I wanted to review all my short put vertical positions, why did that not come in? Oh, I don't have an exit on Microsoft, so we have to add that as well. Now we might just want to come and look at Microsoft on the chart and say, okay, if this is moving up, does it look like a hammer pattern here? It doesn't. So we might just let this continue to roll because we're going to get time decay working in our favor, but we want to make sure on Microsoft, given that we don't have an order here, we want to put in an exit for this. So we're going to come in here and say, hey, when this is worth about 29 cents, we want to buy this back. So we're going to right click, create a closing order to buy it back when it's worth about 29 cents. And make that good till canceled. Okay. And then American Express, we took a pass on. Okay, I want to come down and look at Coke. And this was another one that was, listed in the Dow. And so we had done a short put vertical back in August and that one worked out. We're out of that. So we're going to just, we can just get rid of that drawing now. But this stock has continued to move up. It gapped up after earnings, up 28% year to date, and that's a lot of movement for a stock that is in the consumer staple category. This is one of your steady Eddie kind of stocks, has, paid a dividend forever and a day. And if you're wondering what the dividend is, it's 2.3%, even with how much the stock has moved up. Okay. And one thing I will say about dividends now is there's no guarantee Coke will continue to pay dividends. And the second thing is that we don't actually get paid paper money dividends in our account. But if we look at this and say, well, this might be appealing to some people, could we come down here and sell a put at 89 and do another one of those short put verticals? So, we're expecting it to move to the upside and it may or it may not. Or, could we buy some shares and put in a target at 92.50? Oh, looks like it hit our target on Microsoft, so we're out. So, could we, or could we do both and then just compare them? So if we come out to Coke and say, well, if we looked at this 88, do we have a tight bid-ask spread? 6, that'll work. Does it trade more than 1 million shares a day? Check. Do we have at least 20 times the number of contracts we're interested in trading? Yeah, looks like it. And could we sell our vertical? Now it will do the smallest amount. So we want to make this 87. We get 30 cents. That doesn't sound like much, does it? But we're making 30 and we're risking 70 a contract. That smells like it's 40 some percent. That's 43%. And our guideline is we wanted to make at least 21. So that's not too shabby. And could we come out here and make it $2 wide? We're at 88 and 87. We could come out to 86. We've got tons of volume here, but would we get 60 cents? We get 51. So again, we're going to go, yeah, I think we're going to go with the tighter bid-ask spread. If we're risking $70 a contract and we can risk $500, then how many of these could we do? We could do 7. So if we said, okay, we're going to sell 7 of these. And if you come to confirm and send, it'll say you're risking $490. Most we can make 210. Well, like that's our goal for the week right there. If it works out. And sometimes they don't. So it's like just because you have one good week, you may want to put extra money aside, because you may have some weeks that are not so good. And we've had some of those not so good weeks. In fact, last week or this week was one of those. So we're going to create an opposite order and say, hey, when this is worth 6 cents, we want to buy these back. Good till canceled, confirm and send. Now, this type of trading strategy, it takes advantage of time decay. And so if we were to do a long buy a call, then time is working against us. But with this one, we're selling something, we want to get paid more and then have it become worth less. So we're going to do a stock trade on this as well, and then we can compare the two. Okay, so we're going to put that in our short put vertical bucket, and then we can compare them. So when I want to add something, I just add it, and when it fills, it will go into our short put vertical. But what if we wanted to buy shares? Like we have 23,750 sitting in our account, kind of doing ding qua qua, right? Like it's not making us anything right now. So maybe we could take some of that. And remember, our goals are short term. Maybe we want to take a trip at Christmas or take the kids to Disneyland or, put it in our new car fund. So could we come up here and make it 92.50 and do a swing trade with stock? And then where would we put our stop? Well, we might say, here's our recent low here was 88.96. So I'm going to take 3% off that, 88.96 times 0.97. I'm going to make my stop 86.29. So if it breaks below, we don't want to hang on to this forever and ever. Our expectation is that it's going to continue to the upside. And so how would we do that? And again, how much could we buy? Well, if we said we could buy $5,000 worth, and it's currently trading at, let's call that $90, 89.73, we could buy about 55 shares. So let's do that. Let's come in. We're going to right click. We are going to buy custom with an OCO bracket. And so when do we want out? We want out when it gets to 92.50, right? 92.50. You might say, well, you're buying at 89.77. That's not a very big gain. Well, it's like $250. $250, $273. So if you said, well, if I could make $273 on an investment of $89.77, that's 3%. You may say, well, 3%, like I am not calling home to rave about that. But if you could make that in a week or two, that's not too shabby. Like that's a base hit. That's $250. There's your goal for the week, right? Well, and that would be, sorry, we're buying 55 shares. So if we could make 250 times 55, so it's not quite, it's not our goal for the week. 55 times, say we're making 273, 150. It's still something. Okay. And so in this class, we're looking more for the base hit than the home runs. And that has worked out fairly well for us. The last few months, we've been kind of like the little duck treading water because we've been at this, we were almost at 34,000. And then we had a really bad week. It was humbling. But sometimes the market will do that. And that's why you've got to be consistent and disciplined and yeah, so to get to our goal, if we'd want to make 10,400. We hit our first goal. Our first goal was to make $100 a week, and we had achieved that relatively quickly. So that would have been at 30,500. And keep in mind, there are some paper money fills, and we don't pay transaction fees, and like there are some nuances and differences between a live account and a paper money account. But that's why we changed it. So we're going to compare this to our short put vertical. That's why we changed our goal to 200 a week. So we still have a whole quarter left. So that's that one. Let's also look at Merck. So similar theme here. And if you want, like we can add these to our charts. This is our stock target, right? And show that on the right. And then this is our short put vertical. So we can just put in here short put vertical. And it was 89.88 and expires September 18th. And so when you're clicking on these, you have to make this on the right. When you're clicking on these and going through your charts, you can very quickly then see what trades you have on. And then the other thing that I will often put on the charts, and sometimes I do this after class just so we can move a little more quickly. We put this trade on today so that when we go back and we're doing a postmortem, it's like, did our entry day make sense? So this, when we're placing a trade, yeah, I would call the trade desk if you're advanced order drop down, or you can pick. So let's just say we're doing this. You can pick. I don't think I can. Somehow, for some reason, when I hit this drop down, it comes up on a different screen and it won't let me move it to the screen you can see. But it's first triggers sequence, first triggers OCO, blast all. You could choose first triggers all also, but call the trade desk and they'll help you with that. Okay, so we wanted to go look at Merck. So here is Merck. And I mean, up 40% year to date, having a pretty good year, gapped up recently. And it wasn't an earnings related gap, but this is what they call kind of a gap and run. Typically you want something with like a little less of a tail, but that was a pretty big gap. And then it's come back down to this support level around 145. And so today, this candle is red because it's still trading lower than where it was. It closed yesterday, but it opened lower and is now moving higher. And so if you looked at that, could you say, well, and you may want to come and look at the news, like what's been happening with this stock and, why has it had this move? And I think there was a drug approval here for a cancer product dealing, I believe, with melanoma. And and so if we're bullish on this and our expectation is that the stock is going to continue to do well, and we may want to come out here and look at this PE is high, but they just had a drug approved that could help a lot of people. And so if we come out here and we say, well, we're in the moving business, we don't want to buy a lot for a long time, but could we buy some shares and then put in a target of this around 156? And again, if we can sell at 156 and we buy at 147, call it 147.40, like that's $8.60. And if we divide that by what we're paying to get in, our 147, let's call it 50. So this is approximate, that's a 5.8% return. And what's the advantage of buying it today? Well, the advantage is if we want to put our stop below a recent support level and we see that support around 145, then we have less risk, per share. Now, there isn't a guarantee with a stop that you're going to get out at the price requested. And if it were to gap up, we could get out higher than where it was, our exit target. So it can kind of cut both ways. It can work for us and it can work against us. Okay. But so if we said, okay, I see 145 as a support level, I'm going to put my stop 3% below that. And you could make it 2%, you could make it 5%. I'm just using 3% as an example. So our stop would be at 140.65. And so how much are we risking? Well, we're risking $7 a share. Okay. So I'm going to write that down. My stop is going to be at 140.65. And so we can't risk we don't want to risk more than 500. But how many shares could we buy at 147 a share? So 147.50. I must have 5,000 divided by 147.50. So we could buy 34 shares. That would be our $5,000. And then if we're risking $7 a share, that's about $237, which is our risk per share to the downside. Okay. And so if we said, okay, we're cool with that, even if it gapped down and we got out for a lower price, hopefully we'd still be within that $500 bandwidth. So we're going to buy custom with our OCO bracket. How many shares are we buying? Did we say, was it 33? And then when I click here, it evens them up. And our target on this was 156. Let's call it 156.50. And our exit 140.65. Now, some days, we come in and Monday was like short put vertical day. Like all of our trades were short put vertical. Today, I wanted to show you a variety of trading strategies. And so here we're risking $7 a share for the opportunity to perhaps make $8.88. And our position size, 48.70. So we might be able to add one more share. We're going to leave it at 33. And this is our stock with targets. Okay. Fire in the hole. Okay. So that's a stock trade with a target. So that's a swing, basically a swing trade. We've now done 2 of those. Now I want to take you over to Visa. And there we go. Oh, and Merck. I'm going to take this and activate it. And we're just going to move it up here. Well, we'll edit it. It was 156.50, and this is our stock target. Put that on the right. And when did we buy it? We bought it today. Okay. I may put that other line back there just for reference. Okay. Oh, man, time flies. So here's why I wanted to bring up Visa. First of all, it's in the financial sector, and the financial sector has been rocking. Like if we come and we look at the S&P 500 sector indices and we look at financials, I mean, it is really close to all-time highs. And so if we come and we look at Visa, I mean, it has gone from 293 to 385 since the beginning of April. So if you bought that, it turned out you were no fool. And we have this bear flag, right? And it's now, we have a hold here. So if it were to close right now, we'd have a close above the high of the low day. And so we have an entry. And so could we do a short put vertical here? We could. But could we also do something more directional, and say, buy a call at 380 because volatility is low, and then sell a call at 385, which was the high 2 days ago. And so this is a little bit more directional, but it only has to go up by $3.22 for us to ultimately have our max gain. And again, trades more than 2 million shares a day, lots of volume at the 380 and 385 strikes. Bid-ask spread is acceptable. So if we look at buying a vertical, now if we did this, and we could do this at 380 and 382.50. Let me just close this. We don't have as many contracts, but we have as many as we need. But this bid-ask spread is wider. And so if we said, well, we're willing to be a little bit more directional and make this the 380 and 385. And now this doesn't want to play. So this is another times 2 strikes. So hopefully this will give me what I want. So I want this 380, 385. So here we're paying 290 for this. But it's already halfway there. And so our goal on these is to make 50%. So we'd want to exit this when we're at $4.35. And if we're risking $290 on this, because we could lose all of it, how much can we do? How many contracts can we do? We can do 1. And we're going to make this, well, it's come down just a smidge. So our target's going to be, call it 430. Good till canceled, confirm and send. And we'll put that in our long call vertical bucket. Now, all of a sudden things are acting up. So I'm just going to put this in. Now, if you wanted to compare it, we could compare this to a short put vertical. And I'm going to put that one in after class because we do have to wrap things up. But we could also sell a put here around this, 375 mark. Here, let me get rid of this and come back to single. So if we did the 375, we'd get enough premium here for this to be worth it. And 370, we'd get $1.21. Again, this is a little closer, but it's not, it's still 9. We'd want, to get if we're doubling the risk, 375, 372.50, we'd want to, well, that's $1.22. And we're at $1.21. So let's do this $2 wide. How many are we going to do? We're going to do one. And then we're going to compare it to the long call vertical. And so we're going to make this 22 cents, 24 cents rather. We want to buy this back and then we'll compare them. So guys, that's a wrap for today. I appreciate you being with me. Please hit the like button, subscribe to the channel. Make sure that you're following Scott and I in the land of LinkedIn and in the land of X. Please know there are scammers out there. If you get an email from me inviting you to a private event, if you ask, if somebody reaches out to you on Telegram or even on X, know that I will never offer you a Bitcoin, a crypto deal, private education for a fee, none of that. These are all scammers. And if one approaches you, please let me know. So thanks, guys. Have an awesome weekend. I will see you on Monday. Take care. Lots of great content still coming up, so stay tuned.